You can earn $250,000 a year and still die broke. Conversely, it is possible to earn less than half that and build an 8-figure net worth by making 15 specific structural decisions that most professionals never execute. The difference is not intelligence, it is architecture. It is the systematic conversion of earned income into an autonomous asset base. The average professional earns significant capital over a 40-year career, yet most retire with near zero liquid net worth because they conflate earning power with wealth building. Without financial architecture, high income is just lifestyle acceleration on a timer. Move 1 is a psychological shift. Your job title is not your net worth. The moment you adopt a sovereign mindset, where your salary is just one revenue stream feeding a larger portfolio, your entire decision-making calculus changes. Move 2 requires ruthlessly capping your lifestyle burn rate. Wealthy operators maintain a permanent gap between earning capacity and personal expenses. If your burn rate matches your income, you own zero optionality. Every lifestyle upgrade is an anchor, locking you into future employment. Move 3. Build your personal brand as a discrete financial asset. A strong reputation attracts inbound deal flow and commands premium compensation, which drastically reduces the need for aggressive networking. Move 4 involves acquiring high-leverage meta skills, persuasion, data analysis, and systems thinking. These are industry agnostic and raise your market value regardless of your specific role. A software engineer who masters enterprise sales moves from simply coding features to successfully selling multi-million-dollar contracts. That shift recalibrates your compensation by disconnecting it from standard career ladders. Move 5 is establishing your first yield-generating asset immediately. Even a small rental property or a dividend position forces you to prioritize cash flow optimization over pure consumption. Move 6, automate your capital deployment. If your investing relies on manual willpower, it will fail during market downturns. Set transfers to occur before you ever see your disposable income. Move 7 is mastering strategic debt. While consumer debt is financial suicide, commercial debt is an accelerator. Using asset-backed leverage allows you to acquire cash-flowing assets at a cost lower than the asset's return. Move 8 shifts your tax focus from simple compliance to proactive strategy. Working with a tax architect to structure depreciation and entity frameworks throughout the year creates an arbitrage opportunity that compounds annually. Move 9. Build a private advisory board of operators who are further ahead on the trajectory. You cannot think your way out of structural blind spots. You need perspectives from people operating at a higher scale. Move 10 establishes a formal quarterly asset review. Treating your personal finances like a business entity forces disciplined rebalancing and prevents your strategy from drifting. Move 11 is acquiring at least one piece of appreciating real estate. A single strategically acquired property teaches the mechanics of leveraged acquisition and asset management. Mastering these structural tools, tax strategy, automated deployment, and strategic debt, replaces the linear progress of a basic savings account with the compounding power of an integrated asset machine. Moves 12 and 13 involve transitioning from selling hourly labor to selling outcomes or equity. Passive income streams, like royalties or profit sharing, remove the psychological shackle of total employment dependence. Move 14 is creating a formal wealth operations manual for your household. Documenting your investment philosophy and debt management strategy ensures your plans survive market disruptions and becomes a permanent decision-making baseline. Move 15. Commit to 15 years of execution. Most professionals abandon wealth-building frameworks after 2 or 3 years because they don't see immediate results. Real compounding occurs over multi-decade horizons. The difference between starting at age 25 versus 35 is the exponential leverage that those extra years of compounding create. Generational wealth requires a transition. You must move from being a high-earning employee to building an autonomous machine that works without your physical presence. Every career built on personal performance has a structural limit. Eventually, cognitive capacity will degrade, and the ability to maintain 80-hour weeks will fail. If you spend your entire career trading time for paychecks, your income stops the exact moment your labor capacity stops. These 15 moves provide the architectural blueprint to build a capital machine that functions independently of your physical presence. Subscribe to the Money Formula and join our community of professionals building sustainable wealth. Don't wait until your earning power begins to fade. Drop your primary execution focus in the comments below, whether it is real estate, business equity, or tax restructuring. Take action today. Your future self depends on the structural decisions you make in the next 90 days.